Okay, let's get started. Good morning. How was everybody's weekend? Tiring. It's 1 week away from spring break, right? So you guys hopefully could get some rest and catch up with some studies during the week. So today we have a little bit of chapter 6 to cover, and then we'll move on to a new chapter, chapter 8. So chapter 7, if you go back to our syllabus, chapter 7, we'll wait until after chapter 9 to cover it, because it's a little bit loosely linked to other chapters, and relatively it's easier. So I want to move the more complicated chapters up front so you have the time to review it during spring break. Okay, so chapter 6 we talked about different inventory costing methods. Remember we talked about FIFO, what else? LIFO, average costing. So we talked about the case when purchase cost is rising. Remember when purchase cost is rising, if we use FIFO, what turns into cost of goods sold expense, it's the least cost. So we have a lower cost of goods sold for FIFO, and we have a higher gross profit for FIFO. For LIFO, again, in the case of purchase cost rising, LIFO, we have a highest cost of goods sold expense and the lowest gross profit. Average costing is always somewhere in the middle, because every time we make new purchases, we calculate a new average cost. So after learning inventory costing methods, we also talked about an issue on inventory. Whenever there's a replacement cost that is lower than our original purchase cost, we need to adjust our inventory cost based on that replacement cost, because we don't want to overstate our inventory. Now here's another issue introducing you different inventory errors effect. So since inventory is a very important asset for merchandisers, it's very important and crucial to represent the numbers that based on the realistic products we have in the warehouse. So now inventory, let's say at the end, remember for perpetual system, we always have to do a physical count of inventory at the end, even though we constantly use barcodes to keep track of purchases, keep track of sales. So if, let's say, we had an error that occurred, the red box here, if we had an error that overstated ending inventory, this actually leads to a chain effect toward other accounts. Now, the reason why I say this is because remember, every time we journalize an entry on sales, we have cost of goods sold affected. We also have inventory affected at the same time. Each and every journal entry affects two accounts. So if at the end we overstate the ending inventory, what happens to cost of goods sold expense? Remember, the total inventory available for sale to customers is the same. If we have $1,000 worth of DVD players in our warehouse, if we sold $1,000 worth of DVD players, let's say we sold $800 to customers, what's left in our warehouse is $200, right? If we sold $700, what's left is $300. If we overstated this $300, if we overstated it as $400, that means, on the other hand, our cost of goods sold is understated, because the total is still the same. The total available for sale is $1,000. So these two accounts have the opposite error effect. If you overstate one, the other one will be understated. If you understate one, the other one will be overstated. It has the opposite effect because every time we journalize an entry, we have a debit side, we have a credit side. And expenses, when you debit it, the other side you always have to credit inventory, or the other way around when you do adjusting entries. So this has an effect if we do physical count of inventory. If we accidentally overstate the ending inventory, what happens at the end, since our total, assuming our cost available for sale calculation is correct, at the end our cost of goods sold, based on this overstatement, will be understated. And if our cost of goods sold expense is understated, what happens to net income? Expense understated. That means at the end, it's matched against revenue, and our net income will be overstated. Net income overstated takes into retained earnings. Retained earnings appears in balance sheet. So there's a chain effect toward this error effect based on ending inventory error or cost of goods sold error. So here's an example. If we have an overstatement of ending inventory, the other side, this affects the same entry, cost of goods sold expense. And at the end of the period of time, if expense is understated, at the end, expense is too low, our net income, gross profit will be too high. Okay, so this is an effect of the accounts based on one of the account error, how this affects later on the accounts. Remember in Chapter 3, we also talked about adjusting entries. Midterm, we had a question on depreciation expense. If an expense account accumulated depreciation, it's erroneously stated. This also affects balance sheet, plan assets, total value. So every type of error at the end always affects income statement or balance sheet some way. So you have to know the direction of the error. Okay. So another example would be, let's say ending inventory is understated. So again, the total available for sale is still $1,000. If your ending inventory is understated, that means on the other hand, your cost of goods sold recognized is overstated. So if your expense is overstated, what happens to net income? Expense overstated, that means you subtracted too much. Your net income will be understated. Your gross profit is also understated. Okay, so this is just pointing out that inventory asset is very important. If this part, there's an error that happened in the account when you recognize it, when you post it, this affects later on the balances and affects later on balance sheet. Yes. Sure. If expenses are understated, if cost of goods sold is understated, that means you subtracted two less. Right? You should have subtracted 500, but you only subtracted 100. So your net income, your gross profit will be overstated. The reason why it affects both of these is because, remember, in the multi-step income statement, cost of goods sold falls under the first section. So that affects the first subtotal gross profit. It also affects operating income, also affects net income. If ending inventory overstated, cost of goods sold has the opposite effect. But gross profit, net income has the same effect direction just as ending inventory. Okay, so I hope you can understand the logic, try to understand it, but if you really find it difficult, the shortcut for this is that cost of goods sold has the opposite effect toward all the others. If you have an overstated ending inventory, your net income, your gross profit is also overstated. Only cost of goods sold has the opposite effect. Right? But really the reason why is because these two, add them together, is the total cost available for sales, which comes from your beginning purchase and all the new purchases you made in this period of time. So if that share, if that total inventory value is correct, if you had an error on one of these two has opposite directions of effect. Okay, so again, the opposite example, if we have understated ending inventory, that means at the same time our cost of goods sold expense is overstated. And that's the only account that has the different direction compared to others. Right? So your gross profit, because of this overstatement of expense, your net income, your profit, you subtracted too much expenses. These two will also be understated. And this, at the end, turns into retained earnings. So your retained earnings will also be understated. Okay, let's apply this concept to an example. Okay, so what we just talked about was one period of time. If we carry on the error effect, before we get into the example, here is multiple period of time. So this is giving you an example that if, again, our inventory, let's say it should have been $10,000, and now we accidentally miscalculated it. We listed as $15,000 ending inventory. So this affects, at the end, our cost of goods sold. Since this is overstated, this is understated. Should have been $50,000, but we only have $45,000. And now our gross profit also. Is it overstated or understated? Because this is overstated, this is also overstated. Only cost of goods sold has the opposite direction. And remember, what turns into next period of time is the permanent account balances, which means, is ending inventory carried on, or is cost of goods sold expense carried on? Permanent accounts carries on to next period of time, right? We always close expenses and revenues, so definitely not cost of goods sold, but ending inventory carries on to next period's beginning inventory, right? Ending inventory and all the other current assets, long-term assets, liabilities, stockholders' equity, all carries on to next period's beginning balances of balance sheets. So this ending inventory overstatement also affects next period of time's beginning inventory to be overstated. And this, assuming everything else is correct, this will still lead to an error here. So the beginning inventory is overstated. If our ending inventory this period is correct, this part, cost of goods sold, it still will be overstated. And the gross profit will be understated. Okay, so this is the effect that just comes from this ending inventory overstatement. This leads to next period's beginning inventory to also be overstated. But then this effect just stops here. If we only have one type of error that occurred here, this effect carries on to next period of time, but then stops here, because at the end, if this is correct, what carries on to third period of time is only this beginning inventory, and assuming this is correct, then this will not affect the third period of time. Okay, so in summary, the error effect that happens in ending inventory has the opposite direction toward cost of goods sold, and has the same error effects toward gross profit, toward income. But don't forget that this ending inventory overstatement or understatement also carries on to the next period of time, because it's an asset account. It's a permanent account, and that balance will turn into next period's beginning balance. Okay, so it's important to know what are the accounts that will affect later on period of time. So for example, this account here, this $45,000, even though there's an error, but it closes out in this period of time, it wouldn't carry on to next period of time. Okay, let's take a look at an example. Let's say the bakery here, we have sales revenue of $52,000, and it tells us that the cost of goods sold worth $22,000. So assuming that this part here represented is actually, there's an error in the middle, and it tells you that A situation, assume that ending inventory is overstated by $6,000. So let's just take a look at A situation, don't look at B yet. If A is ending inventory is overstated, so what happens to cost of goods sold expense? Understated. So if this is understated, how should we fix this? If we want to restate the financial statements, if we notice this error here, this is understated. So what is the correct number then? We have to add back the $6,000. So this part is $28,000. What about this? We have to subtract it, right? Because earlier we subtracted two less of expenses. So to correct this, if we notice this error, to correct this, we add back the understatement. So this is situation A. If ending inventory right now is overstated. On the other hand, since every time we journalize entries, inventory comes together with cost of goods sold expense. On the other hand, cost of goods sold will be understated. So we add back this $6,000 to figure out this correct number. And this correct number leads to a correct gross profit. So it also changes gross profit. Because remember, gross profit is the difference between retail price and the cost. Okay, so this is the first situation. What about B? If inventory, another example, if it's understated now, what we have in our warehouse is understated. That means what we recognized as the cost that we sold out to customer is overstated. So if we come back to this example here, let's say this is overstated by $6,000. What is the correct amount? We have to subtract $6,000. So we have $16,000 here. What about gross profit? Add it back, goes up, right? So it becomes $36,000. So the second situation is an understatement example. Again, if ending inventory understated, then our cost of goods sold is overstated. So if this amount is overstated, the correct amount, you have to lower it down. So we lower it down by subtracting this $6,000. We have $16,000. So the correct gross profit, we should add it back. Right, so the direction, if you look at just ending inventory and gross profit, the error direction is the same. Whenever ending inventory is overstated, the gross profit earlier was also overstated. If ending inventory is understated, earlier your gross profit was also understated. You have to add it back. Okay, so this is just pointing out some of the error directions that you have to know how these things affect the balance sheet, how it affects the income statement. So this is pretty much all about Chapter 6. Chapter 6 bridges on from Chapter 5. So Chapter 5 we introduced sales side of the entry. We started off from purchases side. Introduced the operating cycle, purchasing inventory, all the issues that relates to purchases. Remember, we have original purchase costs, we have discounts, we have returns. Sales side, again, we're just switching our roles. We're becoming the seller to sell the inventory to customer. We also have sales-related issues, for example, sales discounts, if we offer to customer, sales returns, and allowances. Now, in this chapter, we're just taking a narrower aspect to specifically look at inventory. So earlier, we just give you, in Chapter 5, just directly give you the number for cost of goods sold. Now we learn different inventory methods to actually calculate and assign cost of goods sold whenever we make sales to customer. So this is the core of Chapter 6. You have to know different methods, how it works. And at the end, what is the gross profit differences by using different methods? How do we interpret these errors if we have errors that occurred in ending inventory? How would this affect later on the statements? Okay, any questions from this chapter before we move on? Now, we'll be posting the announcements on the extra credit quiz after spring break. So basically, it will cover Chapter 3, 5, and 6. Remember, in the book, there's quick check section, multiple choices. I'll be picking 10 questions from those questions. Okay, so each question worth 1 credit. This will directly be adding on to your midterm grade, right? So the reason why I included Chapter 3 is because most of the questions that most of you did wrong belongs to Chapter 3. So I want you to also review adjusting entries because that leads on to later chapters as well. Okay, so it'll be on Chapter 3, 5, and 6. Yeah. Yes. Adding on to midterm. I will make an announcement later as well, but it will be on Chapter 3, 5, and 6. Spring break, when we get back, the first Monday class. Spend about 20 to 30 minutes, okay? Sure. Depends on the situation here. If ending inventory is overstated and cost of goods sold is understated, which is why we want to add it back to figure out the correct amount. Okay? Okay, if no other questions, let's move on to Chapter 8. So Chapter 8, Receivables, what we're trying to do here is, remember in the operating cycle we talked about in Chapter 5, we have purchases, we have sales. So what happens after we make sales, if it's sales on account? If it's sales on account, we also need to collect the money from customers. So if it's on account, this relates to receivables, accounts receivables. And this chapter here will be covering issues on cash collection. So earlier we just assumed that all the sales we make, we will be collecting the money from customer. But in reality, some part of it, in reality, certain percentages, it's very likely that we will never collect from customer or simply collect it after it's past due. So here are some of the issues that how we estimate the part, the uncollectibles part, and recognize it in accounting. Okay, so this breaks down to allowance method and direct write-off method. So we're trying to estimate the part of the receivables that we may not collect from customer and journalize it first. And then other issues is if customer later on pays us back the total amount of money, how do we reverse the entry? Okay, so it breaks down to 2 methods, and on Wednesday we'll cover notes receivable, which we haven't touched upon in previous chapters. So receivables, the general concept is this is an asset account and it's future cash collection. So this could include accounts receivable and also notes receivable. Now the only difference between these two really is that notes receivable also includes collecting interest. But accounts receivable, normally we don't have interest involved. So accounts receivables comes from making sales to customer on account, meaning not directly collecting cash at the moment we provided the sales, provided the services. But we usually bill the customer, send a statement, send an invoice to them, and then later on, typically after a month, or sometime within a month, we will collect the money from customers. So this is the basic concept of receivables, cash collection later on. It represents future cash but it's not cashed yet at this moment when we recognize it as accounts receivable. Notes receivables, we're not just collecting the sales or services by its principal amount, but also additional interest involved. Because usually notes receivable has a longer period of time. It's usually longer than a month. A couple of months, it could be more than a year as well. And notes receivable, we'll wait until Wednesday to go over in more details. So accounts receivables, it starts off from making sales, providing services to customers. And then if we're not collecting cash directly, we have to increase accounts receivables account. So earlier, whenever we talked about accounts receivables, we assume there's only one account for all the customers. But in reality, really this breaks down to many different accounts. Okay, so if we have 10 customers, we have 10 subsidiary accounts receivable accounts in our ledger. So meaning that this accounts receivable really is a summary of all the customers' accounts receivables, all the customers' sales on account, basically that make sales transaction and agreements with us. So if we have 10 customers, we have 10 subsidiary T accounts, we separate each customer's accounts receivables, but then at the end, in our statements, we add them together, represent the total dollar amount in accounts receivable. So this here really is a control account. This breaks down to many different customers' accounts because each and every customer may have made more than one purchases with us. They may also have returns. We may also give them discounts. Remember in Chapter 5, we talked about different purchases and sales issues. So these could be very complicated if we group them all together, if we don't separate them. So usually, to control each and every customer's receivables, we will break them down into separate accounts. This we call it subsidiary accounts in the ledger. And then at the end, when we generate statements, we just put them together. This is the total amount of all the customers' receivables in this period of time. Okay? So this is just a concept of how accounts receivables works. In T accounts, in the journal, we usually separate them. So in the journal entries you see in the chapter, usually you will see accounts receivable / the customer's name. That means that specific subsidiary accounts. So at the end in the statements, that's a group of all those customers' accounts receivables. So after we make sales to customers, this next step will be, while we ship the goods, or typically at the end of the month, we'll be giving out the invoices to them, basically billing the money to customer, reminding them to pay us back the money. So giving out the invoice is a step that starts off the billing cycle. So then if we grant them also discounts, customers may pay us back earlier, within a month, within a week, or 2 weeks. If not, they usually are supposed to pay us back the money within a month, based on the sales, based on the services, the dollar amounts, based on the agreements. Okay, so this is how accounts receivables work. We bill them by the sales revenue, by the service revenue. Later on, we wait to collect the money 2 to 4 weeks, typically a month. Notes receivables, again, this is more formal than accounts receivable and usually involves signing off on a promissory note. And this notes receivable is cash collection for usually a longer period of time compared to accounts receivables, and also involves interest. So the interest could be a percentage decided based upon you and your customer, could be different in different sales agreements. Okay, and we'll wait to talk about how to calculate interest, how to calculate maturity date, how to calculate total collection money on Wednesday. We'll cover those entries. The general idea is that it not just involves the principal amount, but also interest, and usually the time period is longer than accounts receivable. It could be a short-term notes receivable, it could also be a long-term one. It could be within a year, it could be longer than a year. But accounts receivable is always current asset. It's always shorter, within a year. So the allowance method on uncollectibles, what we're trying to do later on in the next few slides is to estimate a pool of uncollectibles accounts receivables. Meaning we want to estimate a part of the receivables that we may not be collecting from customers at all up front before they actually make the bad debts, before they actually pass due the accounts receivables. So this all starts off from the general sales entries. So this is the entry that we covered in Chapter 4 and earlier chapters. Starts off from, for example, August 8th, we provided services to a customer called Brown that worth $5,000. The same day, we also make sales to customer that worth $10,000. So based on these two sales and services, we bill the customer by this dollar amount, and most likely they need to pay us back the beginning of next month. So what happens is the normal process is at the end of the month or earlier than that, they will be paying us the full amount of money that they owe us or our company. So here's an example that they pay us back part of it, $8,000, $4,000. So we collected part of the cash, $12,000. So what if later on some part of the money they just never paid us back? They passed the due date, they passed several months, and it just becomes bad debt, uncollectibles. So we're learning in the next few slides how to estimate this part of uncollectibles based on prior experiences. So selling on accounts, the benefit of this, again, earlier is that even if customers do not have cash on hand now, we can still make sales to them, right? We can still make sales to them based on accounts receivable. It doesn't necessarily have to be cash sales, cash purchases. So this increases and expands our customer pool. This is the upside of making sales on accounts. But the downside would be customers may not have the ability to pay us back the money in full or even the total amount of money. Okay, so this is the downside. This is the cost of doing business by making sales on accounts. So in companies, in accounting, remember we always want to be more conservative. And also, there's a grounding principle in accounting called matching principle. Remember in Chapter 3 we talked about matching principle. We want to match the necessary cost against the revenue in this period of time to figure out net income. So based on those principles in accounting, we always want to measure upfront what is the possible uncollectibles that may happen in this period of time. Even though it hasn't happened yet, we still estimate a pool of bad debts, of uncollectibles, upfront, recognize it as possible expenses. Okay, so this breaks down to different methods. Most of the companies, we use allowance method. Allowance method, we will estimate a pool based on prior experiences. So this also breaks down to two different methods. Most of the public traded companies, and GAAP basically recommends and SEC requires public traded companies to use allowance method, estimating a pool of uncollectibles upfront before bad debt actually happens. The write-offs is the opposite method, basically only recognize bad debt expense whenever it happens, as it occurs. Okay, so these are two different methods, but this first one is recommended and also restricted for public traded companies to use unless SEC grants them otherwise. So unless that company only has majority of cash sales, they don't make sales on account. Otherwise, they have to use allowance method because this properly matches the expenses against the revenues in this period of time. Okay, so in more detail, let's take a look at how allowance methods work. Basically, the underlying assumption is that, again, goes back to Chapter 3, matching principle. We want to be more conservative and always want to measure expenses up front, even though they haven't actually happened. So based on prior experiences, for example, we may have make sales, and usually before prior years, we usually have 1% or 2% of the sales that we just couldn't collect from customers. They kept on delaying after several attempts. They passed 1 month, 2 months, or even a year. Based on prior experiences this year, we still have to estimate that same percentages, recognize it as uncollectible expense. So the two methods under allowance method breaks down to percent of sales and aging accounts. We'll talk about this in later slides, but both methods involve these two accounts. So these two are new accounts. Whenever we estimate a pool of uncollectibles, we have a new account affected, uncollectible account expense. So this is just a regular expense account. So it also follows the regular expense rule. Debit side increase, credit side reduce it. And we usually only use credit side when we close the account. So whenever we recognize this entry, usually we would debit expenses. The other side, when we estimate a pool, we increase allowances for uncollectible accounts. So this is a new contra asset account. Remember the idea of contra asset is reducing one of the accounts. What do you think this account is reducing? Which account? Accounts receivable, right? So usually on the statements, this account, this is the contra asset account, It's listed right underneath accounts receivable. It's a deduction account for accounts receivable. So this concept is just like plan assets. Remember, we have plan assets accumulated depreciation. It's a deduction account for plan assets. Here we have a current asset account, accounts receivable, and the deduction account is the estimation of uncollectibles. Okay, so this part later on we'll be posting something here, just like accumulated depreciation. It has a credit balance because it reduces accounts receivable. Okay, so whenever we make estimation of the pool of uncollectibles, this affects two accounts. Either methods we're introducing later on, percent of sales, aging of accounts, regardless of the methods, whenever we journalize entries, this affects one side, uncollectible account expense, debit balance. The other side, allowances for uncollectible accounts. The contra asset account, it reduces accounts receivable balance. Okay, so this part basically, in words, it's estimating the part of receivables that later on we will not be collecting from customer. So this reduces accounts receivables value. Okay, so if we take a closer look at these different methods. First method, we estimate the pool based on the total sales we make in this period of time. The other method, we base our estimation on the age of accounts receivables. So we will group accounts receivables into the age from older to younger or from younger to older, and then assign a percentage to it to estimate the part that we will not be collecting from customers. So these are two different methods. Percent of sales, just by its name, since sales is an income statement account. Remember, it's the first income statement account. This method has another name called income statement approach. Compared to this, aging of accounts. Aging of accounts, we simply just look at accounts receivables age. So it's called balance sheet approach, since accounts receivable is part of balance sheet. Percent of sales, we measure the part we're not collecting based on the total value of sales we have in this period of time, an income statement approach. Aging of accounts, we group accounts receivables and categorize it based on the age. If it's sales made within a month and we have several customers listed, 2 months, other 2 months customer listed, 3 months and up. So based on the age of accounts, we estimate the part that we're not collecting. This is a balance sheet approach. Let's take a look at percent of sales first. So this is what we see on our financial statements. Right now, assuming that at the end of August, we have an accounts receivable balance, $3,000. And you see another contra asset account, allowances for uncollectibles. Right now, since we haven't journalized the entry, it's a zero balance. So if this period of time we had $15,000 of sales made just within August, within this month, and based on prior experience, every month's sales, we may have 2% of uncollectibles, meaning we may have 2% of them. Either customers will pay us back past due or may not be able to pay us back in full at all. So based on this prior experience, you pull this information from your business's data. So this part, the percentages, will be given to you in all the problems you see in the chapter. You can calculate the pool of uncollectibles up front, even though it hasn't happened yet. So this is the estimation entry we're making here based on allowance methods, specifically percent of sales. Total sales we make is $15,000 within this month. Prior experience, we have 2% of the sales, we just may not be able to collect them at all. So we estimate that this period of time we have $300 of sales as uncollectibles. This entry, we debit uncollectible account expense, we credit allowance for uncollectibles by $300. So this is an estimating entry. Typically in business, every single month they would do this estimation. And together with another method that we'll introduce a little bit later, aging. Aging happens usually at the end, before statements are given out. This estimation usually happens either monthly or quarterly, okay, based on the statement's frequency the company is giving out. So again, what we're trying to do here is to estimate the uncollectibles based on prior experiences, 2%, and based on this month's total sales, $15,000. This gives us the $300 uncollectibles, potential uncollectibles. We recognize this as expenses directly in this period of time. It may change based on the businesses. It's not always 2%. So each and every problem may give you a different percentage. It's based on different businesses. But in the real world, it changes constantly. Okay. So again, here we're trying to use this entry to estimate a pool of uncollectibles based on prior experiences, based on the sales we make in this period of time. We calculate $300 as potential uncollectibles and directly recognize it as expense. Because this is highly likely that there will be $300 at the end of the year we won't be collecting from customers. Yes. Because this is how the method works. This method is using the base of the total net sales, credit sales. This is not the cash sales, only the credit sales. Multiply the 2% based on prior experiences, which will be given to you in each problem. So you're just estimating a pool based on this month's sales value. You have $300. So if other months, if we have $10,000, then this will be $200, right? So based on different years' sales, multiplying 2% will give us a different value of potential uncollectibles. And then this will affect, again, these two accounts, uncollectibles and allowances for uncollectibles. So if this is the only estimation, if this is the total estimation amount for this month, at the end when you see this month's monthly statement, we have $3,000 of accounts receivables and we have a reducing amount, $300, the deduction account. So the net realizable value for this here is $300 subtracted from $3,000. The net value for accounts receivable really is only $2,700. It's still expensive. So in a sense, it's already reduced from revenue at the end. Because if you recognize this, at the end it appears on income statement. So it's actually upfront recognizing potential losses. Right? Because we want to match up. Okay, the reason for recognizing it in this period of time is because usually we realize that customers are not paying us back perhaps next period or next year, beginning of next year. So then if you only wait until that time to recognize it, it doesn't match with this period's revenue. You're recognizing expenses in next period of time, which lowers down next period's net income, which in reality, this $15,000 happened in this month. Okay, so this is also, I just mentioned the downside of the other method we're introducing later, direct write-off. The reason why we're using this method, allowances, and the reason why SEC requires public traded companies to use this is because it estimates expenses highly likely uncollectibles up front and doesn't overestimate the net income for this period of time, and also doesn't underestimate next period of time's income. Okay, so we always measure potential uncollectibles up front before it even happens, based on prior experiences. So this is the first method, percent of sales. Measure the percentages, multiply by sales, figure out this $300, journalize this entry by debiting expenses, crediting allowances. This allowances at the end appears underneath, right below accounts receivable. And just like how contra asset accumulated depreciation reduces planned asset, the same logic, allowance for uncollectible accounts reduces accounts receivables. So really, the accounts receivables that we're likely to collect, most likely to collect at the end, is $2,700. Both. It's both. Accounting period and all the customers' credit ratings. So this belongs to the estimation that in the business, the credit department and also accounting department will work together to figure this out based on the records and the customer's credit rating history. Both. Okay, let's work on an example, trying to see if we get the idea. So this Spring Garden Plans tells us this company, we have sales revenue $322,000 on accounts, so meaning these are the sales made on credits, made on accounts by accounts receivable, not cash sales. So based on industry experience, we have 2% of revenues that are usually listed as uncollectibles. We'll not be collecting 2% of these. So try to, first of all, journalize sales. Remember in Chapter 5 we talked about sales? Just journalize the first entry, sales, omit cost of goods sold, since we haven't given you this information. And try to see if you can estimate percent of sales entry, the entry that we just did, that we just showed in the previous slide. And at the end, what is the net realizable value of accounts receivable after this estimation? What is really the accounts receivable that we're collecting, most likely collecting? Okay, first of all, how do we journalize sales? You tell me, how do we journalize sales? What do we debit and credit? And debit accounts receivable, credit sales revenue. Now here it asks you to omit CDS, so what if we have the cost information? What do we debit and credit? If we have the cost information, we also need to journalize the second entry, debit cost of goods sold, credit inventory. Remember, always sales entry comes together, there's two entries. So here it's less complicated. It doesn't give you the cost information, so you can just omit that entry. So we have sales, debit accounts receivable, credit sales revenue. What about this part, estimation? So if we don't look at the value yet, what do we debit, what do we credit? Debit uncollectible account expense, credit allowances for uncollectibles. It's a contra asset account. The credit side is a contra asset account. So the value, it tells us that 2% of the credit sales, it's likely that we will not collect that dollar amount. So we just multiply $322,000 by 2% to figure out this dollar amount, $6,440. Okay, so the first entry is a sales on account entry. This we covered in Chapter 5. Increasing sales, increasing accounts receivables. Second entry, we're estimating a pool of uncollectibles based on 2% prior experience, multiplied by this period's net sales, net credit sales. So then we estimate expenses directly, even though we haven't actually have uncollectibles that happen. We measure out expenses to satisfy the matching principle in accounting, and also recognize allowances for uncollectibles. So this is a pool of uncollectibles we're estimating here. Later on, we'll also be using this pool if we actually identify the customers that accounts receivable has already passed due. We will be assigning this to accounts receivables. So after this journal entry, at the end of this monthly statement, we have this dollar amount, we have $322,000. So tell me, what is the net realizable value of accounts receivable? After subtracting this, right? So we have the original current asset balance, and then we have the reducing accounts, allowance for uncollectible accounts, reduces the value of accounts receivable. Because we want to be conservative, we want to match up possible expenses against revenue. Okay, so this is the part that we estimate we'll not be collecting from customers. So the net receivable value is this amount. So this is just a partial balance sheet statement under current asset section. We have current asset accounts receivable, and from this chapter on, right below it, we have also a reduction account allowances. Which other balance? So $322,000 is the sales revenue that happened within this month. This is the ending balance, which means part of it we already collected from customer. The difference is we already collected, right? Because that's the way how it works. Because remember that this is a permanent account. So this is a balance from the starting point in the business, all the accounts receivables and all the payments, adding them together. This is the balance at the end, from day one of the business up to now. So the 322, this is this period of time sales, just purely this period, this month, this quarter, or this year. This percentage is based on that period of time only. It's not from day one of the business all throughout. It's not multiple years. Okay, so it's because of this percentages. It's usually just applied to a certain period of time, because usually this changes as time goes by. So it's not constantly, not an aggregated dollar amount. Okay, any other questions? Second method is the aging method. This, again, is still part of the allowance method in accounts receivables, but we're using a different method to estimate the part that we're not collecting. So a lot of the businesses, they apply both of these methods. Percent of sales usually is applied monthly or quarterly based on that period of time sales. And then what happens at the end, they look at all the accounts receivables and group them by the years, by how young it is, how old it is, based on how long it has been outstanding in the business. So at the end of the year, before statements are given out, a lot of the companies, they also apply aging methods just to double check that the uncollectible they estimated matches up with all the accounts receivables balances. So this is a little bit more complicated than percent of sales because the first step will be grouping this information, but most of the problems directly give you this table, this aging table. So then what we need to do really is calculate a balance of the target allowances balance. So meaning that how we interpret this is we have different customers' names, different accounts. Based on the age of the accounts, we group them into a month-old accounts receivable or receivables 2 months old or 3 months old or above that. So we have 2 of the accounts that these 2 customers just made transactions with us within a month. These are the youngest accounts receivables, and we assign a lowest uncollectible percentage to them. Because we assume, this underlying assumption is that the older the accounts receivables are, the higher risk the company is bearing of not collecting the money. Okay, so the younger the accounts receivable is, the least percentage we assign to uncollectibles. Second oldest category, we have 2 of the other customers that has outstanding accounts receivables from 1 month to 2 months. Assign a little bit higher percentage to this. 2 months to 3 months, 5% of uncollectibles assigned to it. Above that, over 90 days, 90% of possibility of not collecting this money. So we'll be multiplying this total dollar amount of accounts receivables based on the age of accounts receivables. So if we multiply this, gives us $19, multiply this, gives us $4, multiply this, 17, this, 360. Adding this all together is our target balance, $400 of allowances of uncollectibles at the end of this year, before we give out financial statements, annual statements. So this is the target balance of allowance for uncollectible accounts. But remember earlier, we already used percent of sales to estimate part of the uncollectibles. So what we're trying to do at the end, based on this aging method, is to match this $400 against what we have in our account right now. And if there's differences, we adjust this dollar amount. Okay, so if we take a look at another example, the target balance, let's say we have accounts receivable. Right now, the balance is $2,800. Allowance for uncollectible accounts, based on percent of sales, we already estimated part of the uncollectibles. So the total value is $150. But remember, at the end of the time, when we look at this total accounts receivables accounts, the summary of the information, and assign the percentages of uncollectibles based on the age of the accounts, we have a target balance of allowances calculated at $400. So this 400 is different from the allowance balance we have right now, 150. So the difference is value. This is the part we need to adjust, this uncollectibles account. So this entry looks exactly the same as percent of sales, the accounts part. We still debit uncollectible account expense, credit allowance for uncollectibles, but we're just trying to adjust this dollar amount so it matches with the target balance. Because percent of sales is a monthly basis or a quarterly basis. Aging of accounts, we're looking at all the sets of accounts receivables, a summary of them. So this is matching the expenses even better compared to percent of sales. We're looking at them all together at the end of the month, at the end of the year, before annual statements, and just adjust the part, additional account uncollectible expenses based on aging of the accounts. Okay, so once again, we're looking at a summary of accounts. We list all the accounts, all the customers, group them by the age of accounts receivables. So the younger the accounts receivables are, the lower the possibility of not collecting the money. The older the accounts receivables are, the higher the possibility, the higher the risk the company is bearing of uncollectibles. So then based on multiplying these numbers, add them together, this gives us the target balance, $400. Multiplying percentages with the accounts receivables value. This target balance is our goal at the end that should be represented in the statement, $400. We just match it against what we have right now, $150, and make the adjusting entries. The difference is $250. So this $250 will be additional uncollectible account expense. We journalize this at the end, December 31st. After looking back at all the accounts receivable. Okay, so a lot of the companies, they use together both methods. Percent of sales for monthly, for a shorter period of time, interim statements. and then use aging methods at the end of the year to look back at all the accounts receivables, make an adjusting entry. This entry still shares the same accounts as percent of sales, but just match up this dollar amount with the target balance of uncollectibles. Let's take a look at an example here. Now don't forget that after this estimation, this $400 is still a deduction account toward regular accounts receivables. So after this journal entry, the net realizable value of accounts receivable is the $2,400. The differences between these two accounts. What's left is the net value of accounts receivable. Okay, let's apply this to another problem. So we have accounts receivables here, $78,000, the balance. And we have allowances, beginning balance, where you can say the balances we have within this period of time so far is $1,900. So at the end of the year, we look at all the accounts, and it tells us that we have a total of $75,000 of young accounts receivables. So we only assign 4% to this. So this percentage is assigned is based on businesses. It could vary. So the younger accounts receivables, 2 months, we assign 4% of uncollectibles. Older ones, over 2 months, we assign 24%. So assuming this problem, they just group it as 2 categories. Try to calculate this total value of uncollectibles first, figure out a target balance, and then compare this against this to adjust the entry of uncollectibles. I think it's not 30. 4% is, do the calculation again. Should be more than that. Yeah. Oh, okay. All right, so now it must be produced. You get these are the target balance, and then we compare it against the beginning balance. So then the differences between this and that would be the part that you need to do another adjustment. Yes. Can you just give me this for a minute? Yeah, it should be $3,000. I think $75,000 and this much. 75. Yeah, and then multiply 0.04. Yeah.
I press shift. That's probably why.
No, don't do that. I don't know what that gives you. That gives you the percentages. That's why. That's like 30%, which means it's $3,000. Yeah. Fantastic. So you have to calculate this again and match it against the beginning balance. And add them together to target balance compared against $1,900. The differences then adjusted. This, you don't have to do anything with this. No. Just add these to target balance. Okay? Okay, what is the value of the target balance for the youngest accounts receivable? 3,000. What about this? So what do you do after these two? Add them up is the total target balance for allowances at the end of the period. Then compare it with $1,900. The difference is you journalize another entry to increase allowances. Okay, so add them together, $3,720. Subtract $1,900 to figure out the part that you need to adjust, which is this part, $1,820. And this part, we journalize another entry just like percent of sales. We're just adding up to the allowance pool, adding up additional uncollectibles based on aging methods. Sure. So we calculate this target balance based on, after categorizing accounts receivables, companies would assign uncollectible percentages based on the age of the accounts and just multiply the percentages by the balances of each category to figure out a target balance. Total is $3,720. So this is the total allowances that should appear on balance sheet at the end. Since this is the ending balance, then we need to compare it with what we have right now to adjust the part, which is the red highlighted part. This is already the target balance that should appear on balance sheet. This is what we have in our book right now, based on percent of sales we made earlier. And the difference is $108,020 would be the part that we need to adjust to increase the estimation pool of uncollectibles. Okay, so far what we covered is just the beginning part where everything starts off from making sales on accounts. And we introduced allowance method and specifically breaks down into percent of sales, aging methods. The percent of sales usually is used for interim periods, monthly, quarterly. Based on every single month or every single quarter's sales, we multiply an industry experience percentages of uncollectibles. So we have an adjusting entry that is made every single month or every quarter. Aging methods complements with that method at the end, takes a look at all the accounts receivables and making sure that this value estimation is properly stated based on all the accounts' ages. Okay, so far what we did is just the estimation part. We haven't assigned and haven't identified actual bad debts. So after the estimation, this method gives us the total balance. You have to know net realizable value again. This is the net dollar amount of accounts receivables represented right underneath the contra asset account, $74,280. Okay, so this is just subtracting this from the original accounts receivable balance, just like how we calculate the net plan asset value by subtracting accumulated depreciation. Yes. This value is based on prior experience to highly possible receivables. Okay, so after the estimation, which happens every single month and at the end of the year, let's take a look at the end, if we actually identify the customers that have the receivables based on the agreement has already passed due. So what happens to those accounts? We have to write off those accounts, uncollectibles, write off those accounts receivable. The companies, they typically have a certain period of time to decide and to determine which are the receivables deemed as uncollectible. Once those period of times occur, so once they identify specifically Jones, the customer, specifically Andrew, the customer, that are not paying back the money, will not be able, highly possible, we're just not collecting this amount of money. What we're doing here is assigning that allowances pool to its specific accounts receivable and reduce that accounts receivable, taking it off from our book. It doesn't mean that this customer no longer owes us the money. It just means that we don't want to overstate this asset because this has already passed due for a long period of time. After several attempts, we're not able to collect the money from them. We don't want to estimate assets. We don't want to overestimate the net income we have at the end, the sales. So we're just reducing accounts receivables directly if these are the accounts that companies already decide these are deemed as uncollectibles. So So remember what we did earlier, we assigned an allowance pool on the credit side. What we're doing now is reducing that allowances and assigning it to the specific accounts receivables. So at the same time, reduces allowances because this is a pool specifically made for the purpose of writing off. So now it's the time we actually identify the customers that receivables are actually determined as uncollectibles, as bad debts. This is the time we write off those accounts using up this allowances pool that we just estimated. Okay, so these are the accounts, the $200 who reduce allowances, assign them to accounts receivables, reducing accounts receivables at the same time. This is what we call writing off the accounts. We're taking the accounts receivables off from the statements. Even though these companies, they still owe us money. So companies could turn these sales agreements, turn these invoices into attorneys or other debt collection companies. They will still be pursuing this money. But in the meantime, since we haven't collected the money, we'll be taking this off from the statements. We don't want to overstate accounts receivable. Okay. Now that was the only entry on writing off. So we're just assigning allowances, reducing accounts receivable. Another case is, let's say after a couple months or just a couple of weeks, if the accounts we earlier write off now recovers, meaning that perhaps Jones came to us and paid us back the money, even though it has been past due for half a year, a couple of months, we still need to recover this entry. Since they paid us back the money, we collected cash. So what we're doing here really is just reversing what we did earlier, writing off. So here, assuming that we already wrote off this account in January, now when it comes to March 4th, 2 months later, they're able to get the money, they're able to pay us back the full amount. So we just reverse the dollar amount, the writing off entry that we just did, bringing back accounts receivables, and then increasing allowances again, reversing previously written off entry. And then this entry should look very familiar to you. This is just a regular cash collection entry. Increasing cash, reducing accounts receivable. 2 different years, you mean they paid us later? You will still recover the earlier entry because previous years you still did this. But then you have to restate earlier the statements. Okay? So earlier, if we already wrote off this entry, this account, then we have to recover this entry. So this is just flipping the entry that we just did in prior slide, writing off the entry. So we're flipping this back by increasing accounts receivable back because this customer is paying us back the money, recover this entry, and then a normal cash collection entry. Okay, so the simpler case should be we make sales to customer on account, and then they just pay us the money. This is the simplest case. Make sales, cash collection. But because based on prior experience, we have estimated percentages of accounts receivables that may become uncollectibles. So this becomes a thing in a business that every single month, or at least at the end of the year, they have to do estimation on uncollectibles. So we introduce percent of sales, aging accounts methods. After we do that, we actually identify the bad debt customers. So we write off their entry. But in the case that they recover the accounts, later on pay us back the money, we reverse that written off entry and then make the cash collection entry. So this is the most complicated case if that we have sales made, we also have estimation, we write off the entries for some of the customers, and then we have to recover them. So this is a complicated case in this chapter is that we have 5 entries related to this specific customer. Okay, so a summary of what we just talked about, we made sales on accounts, we estimated a pool, so the percent of sales, usually that happens in the interim period. Then we make cash collection for most of the accounts. For most of the customers, we will be able to collect the cash on time. Others, we identify bad debt. Based on the estimation pool we did, we write off part of the customer's account if we already decide these are bad debt uncollectibles. So then at the end of the year, we look back at all the other accounts. We also do another estimation, remember, aging of accounts. So at the end, if we wrote off some of the accounts, if they pay us back the money, we have to recover that account by reversing the previously written off entry and then a normal cash collection entry. Let's take a look at all the entries that we just did, not just with what we just covered here. First entry, increasing accounts receivable, increasing sales or service revenue. Second, use percent of sales based on this period of time sales. Multiply an industry experience percentage, figure out a pool of uncollectibles, allowances. Normally, customers will be paying us cash back on time, so this will be just a normal cash collection entry. This is writing off the accounts if these are the customers that we already determined as uncollectible customers, accounts receivable. At the end, we also apply, many of the companies apply aging methods, take a look at all the other accounts together, adjust this dollar amount to 150, match up with a target balance, and then at the end, if we want to recover this, reverse accounts receivable entry, the previously written off one, and then a normal cash collection entry. Yes.
They pay the money off. Are we still keeping that percentage rate the same, or does that go down because they now paid it?
That will be, you mean go back and change it? We don't go back and change the earlier estimation, because really that estimation is the aggregated information of all the customers and sometimes even just the same industry average. So just based on one customer's change, usually it doesn't likely to change that 2%. And also another thing is, unless a case like inventory replacement cost, otherwise we don't go back to change those entries. So if we did an estimation, we already did it. If later on we need to adjust it based on targeted balance, we will be able to adjust it. Remember the age of the accounts receivables? So if they pay us back, that will be basically cancel out from the aging accounts. So that will adjust it. Okay?